Alright, hi guys. So it's the 1st of the month, 1st of August, and as always, I kick off the monthly review with the monthly market analysis. So let's begin by looking at the technical charts of the S&P 500, and I'm using the SPY ETF as a proxy to the S&P 500. So first of all, let's take a look at the shorter term daily candles. This is on about a 1 year time frame, and you can see that the S&P is on an uptrend, but kind of like, moving sideways within the longer term uptrend. So you can see where we are right now. We have got the 20 EMA, the red dotted line, above the 40 EMA, which is the blue dotted line. So remember that when the 20 EMA is above the 40 EMA, the short-term trend is up, right? And the 50 moving average is the blue line when the 50 is above the 150 and the 200 is sloping up. That means the medium to longer term trend is also upwards. Yeah, so the market remains on an uptrend. So that means that the path of least resistance is up and away. All right, the market is gonna tend to trend higher. Now, of course, bear in mind that uptrend doesn't mean go up every day, every week, every month. Uptrend means it can still go up and down, but the overall direction is up, at least for now, towards the end of the year, unless something changes that trend. Okay, but you can see that within this uptrend, market in a way has been kind of like moving in a bit of a sideways consolidation pattern. We can see a support level over here at about 726.79, right? You're gonna wave up, wave down, wave up, wave down, wave up, wave down. Now looks like it could be waving back up, right, within that short-term consolidation pattern. Now, if we take a bigger view, let's now look at the weekly candles. Let's go look at the 5-year weekly candles, and there we are on the 5-year weekly. You can see clearly that this 20 EMA, the red dotted line on the weekly candles, has been a very strong support level, right? So every time it hits it, toing, it goes up, right? Toing, it goes up, toing, it goes up. So that 20 EMA is that first support level that supports the price. Hence, the first support I've indicated is 726.79. That's support level 1. Yeah. Now, how about the other support level? Support level 2, 3, 4. Now, how I identified the rest was on the longer time frame. So if we go on to see the 10-year monthly candles, you can see the much longer term trend, right? So you can see over here that the second support level coincides with the 20 EMA on the monthly candles, right? So you can see here it has been a support during pullbacks, like support here, right? So support here, bounced off there. So that's the second support. Third support is at the 40 EMA, the blue dotted line. So notice this has been a support, has been a previous support. And the last support level is the 50 moving average. This blue line, when we get a major crash, boom, bounces off. Major crash, boom, bounces off. Major crash, boom, bounces off. Now, of course, it can go a bit lower at times, like just during COVID, it hit the 100 moving average, which is this orange line. But unlikely to hit the orange line unless it's a big disaster like another global financial crisis, another COVID. Unlikely, right? So from here, what we know is that the S&P is on an uptrend, and as and when it does drop during a pullback or correction, these are the likely levels it will bottom: 726, 661, 594, and 539. These are the 4 support levels. So again, for those of you who are accumulating the S&P ETF, either through the SPY or the VOO or the CSPX, you can use this as a reference of where to add, right? And we always add in tranches. We dollar cost average in tranches at these 4 levels. Well, at least I do it, and I'm not recommending you do it, but I'm just sharing you my thought process and the way I accumulate the shares of an ETF. So how has the index performed year to date? And let's look at the various major indices for the first 7 months, and we've got 5 more months left to the end of the year. So interestingly, the index that's outperforming this year, which has outperformed all previous years, is the small cap index, the Russell 2000 small cap, up 17%. This consists of all the small to medium-sized companies. Yeah, but don't get too excited, because in the long run, this tends to underperform. It's just playing catch up. Yeah. Second best performer is the Nasdaq 100, up 12% year to date. The S&P 500 up 8.89% year to date, and the Dow Jones, very close to the S&P, up 8.49% year to date. So the next video I'll be doing would be my portfolio review video. And my portfolio, last I checked, is up about 14.4% year to date. So far this year, outperforming both the S&P and the NASDAQ. So let's break it down. Which sectors have been outperforming for the year within the index. So you can see that in the last 30 days, we have seen a rotation, what I call the rotation from the AI bubble stocks to the anti-bubble stocks. And I can see it pretty clear here, right? Because in the last 1 month, the best performing sectors were financials, up 3%, consumer defensives, real estate, healthcare, and consumer cyclicals. These are all the anti-bubble sectors. All right. And the worst performing for the month were the AI-related sectors. Basic materials, utilities, communication services, although this is not really AI, right? Technology, industrials, you can see these are down the most for the month. But to me, it's a very healthy sign. Why? Because for the first 6 months, we had technology and utilities and materials going up, and the rest, which is defensives, financials, real estate, going down. So now these sectors are playing catch up. So this is what we call the broadening of the rally, the broadening of the bull market, which is very, very healthy. Now, the reason why energy is so high up this month because of oil prices. Remember, energy stocks are affected by oil prices. So because the Iran war rages on, the truce was violated on both sides, oil price went up by a couple of percentage points, so energy has outperformed for the month, right? However, year to date, you can see energy is still the outperformer, again because of oil prices, but as you guys know, I don't invest in energy because it's very unpredictable. The moment the war is over, oil prices collapse, energy will go all the way down, So I'm interested in investing in sectors that are consistent and predictable. I'm not interested in sectors that sway because of commodity prices, which is another reason I don't invest in materials sector, as you guys know. If you're new to this, you won't know that, right? So I'm just mentioning. Okay. Technology, second best, obviously, because of the AI bull market, right? Real estate, interesting, real estate year to date is up quite a bit. Despite the 10-year treasury yields making new highs, which are the long-term interest rates making new highs, real estate actually doing pretty well. Interesting. Industrials, consumer defensives, financials, materials, healthcare, utilities. The only two sectors down this year are communication services, like Netflix, like your Meta platforms, for example, AT&T, and consumer cyclical, also known as consumer discretionary, which are things like your Lululemon, your Nike, your AutoZone, your O'Reilly. These are all consumer discretionary. Although bear in mind that Amazon is also classified as consumer discretionary. Amazon is not classified within technology. It's within consumer, cyclical, or discretionary. So that's where we are in terms of the sectors for the year. Okay. So question, is the S&P 500 expensive or cheap? And again, there are many ways to value it. You can use PE ratio, which is the simplest way. You can use the PEG ratio, and you can look at the individual components of the S&P, which now you can use Stock Oracle to look at. Very, very cool, right? So if we look at the overall forward PE of the S&P, as of July 27, you can see the forward PE is 20.1 times. There we are right here. So is that high or low? Well, the last 5 years, the 5-year average forward PE was 19.9, and the 10-year average forward PE was 19. So in other words, it is just slightly above the 5 to 10-year average. Is it like super expensive and bubble? No, it is, I would say it's fairly priced. It's fairly priced. But what's interesting is this. Notice that at the start of the year, January this year, the PE ratio, the forward PE, was 22 times. right? This was January this year. And despite the S&P, the market going up 8% this year, the forward PE has dropped to 20 times. So what does it mean? That means that the market is cheaper today compared to the start of the year, even though the market went up 8%. Why? Very simple, because earnings growth has gone up more than the market price of the companies in the S&P 500. So are we in a bubble in terms of the S&P? No, far. We are fairly priced. I wouldn't even say we are expensive. Now, if we drill down to the components of the S&P 500, we can see how many are expensive and how many are cheap. And now you can do it with Stock Oracle. Just go on to the value radar and just scroll down over here and you can see for yourself. There we are. So currently you can see that we have got 25% of the stocks in the S&P are very overvalued, which means they're selling more than 30% above their intrinsic value. That's about a quarter of the stocks. Then we've got 18% of the stocks which are 10 to 30% above the intrinsic value. So these are both overvalued. And then we've got 27% of the stocks in the S&P which are fairly priced. And we've got 16.8% which are undervalued. And we've got 11% which are very undervalued over here, right? And these colors mark how many are wide economic mode, how many are narrow economic mode, and how many don't have an economic mode, which tells you the strength of their sustainable competitive advantage. And of course, you can also check it out. You just click on this, right? You can see that these are all the stocks that are very undervalued. Doesn't mean that they're all good investments, because cheap crap is still crap. So valuation is not the most important thing. Remember that. Valuation is always secondary. The most important thing is it a high quality, predictable, consistent business? Then we look at valuation. If it's not consistent, it's not predictable, I don't care how cheap it is, I ain't gonna touch it. As you know, I do not look at macroeconomic data like inflation, like the yield curve, like the GDP. I don't look at geopolitics in making my investment decisions. It is completely useless, right? Because no one can make money or predict that with any certainty. But we look at it for entertainment purposes and for general knowledge. Yeah, so just bear in mind, this is purely for entertainment. It has no bearing on my investment decisions, okay? But for entertainment, yeah? So what happened in the month of July? What are some major macro news for intellectual stimulation? Number one is inflation actually cooled, okay? The Consumer Price Index, CPI, came in at 3.5% in June, which is down from 4.2% and softer than the 3.8%, which was expected. Core CPI came in at 2.6%, which is still above 2, but not too bad. But June PCE, which is the Federal Reserve's preferred inflation gauge, that came in a bit hotter at 3.7%. And the core PCE indicator came in at 3.3%. So it's still well above their 2% target. And that's why a lot of people were wondering, would the Fed raise interest rates when they met on Wednesday? But they decided, no, they're going to hold interest rates steady, yeah? Which I agree with. I'm actually in the camp where I think they're going to cut interest rates. Yeah, although everyone thinks they're going to raise interest rates, I think that they're going to cut. But what do I know? I'm not an economist, right? So my guess is as good as yours, okay? Now, labor softened and growth slowed. So the labor market softened a bit, where the June non-farm payrolls came in at 57,000 jobs created versus 115,000 expected jobs created. So labor market is softening. Although unemployment rate went down to 4.2%, the quarter 2 GDP came in at 1.5% annualized, which is below the 2.1% expected. So it's a deceleration. Now, interestingly, soft labor data and GDP softening actually is dovish for the Fed. So that means that the Fed more unlikely to raise rates when GDP and labor weakening, which is ironically good for the market, right? So like I said, the Federal Reserve, they held their rates, but their comments were a bit hawkish, which means we'll raise rates we may, hawkish, but I don't think they will. They're just threatening the market, right? So they held the Fed funds rate, which is a short-term interest rate, between 3.5 to 3.75%. It's the fifth time they've held rates. Liquidity. So the money supply M2 rose 5.5% year on year in the month of June. So that is usually good for risk assets. In terms of long-term interest rates, the 2-year government bond yield is at 4.28%, and the 10-year Treasury government bond yield at 4.75%. So they both rose for the month. Not in danger territory. I would say that 5.5% would be a bit worrying, but we're not there yet. Yeah. In terms of credit spreads, so for investment grade option adjusted credit spreads, it is at 80 basis points or 0.8%. That's very tight. Now, what does that mean? When credit spreads are tight, it means that people are confident about the market. They are confident about the economy. So they don't demand so much more risk premium for investment grade bonds above treasury bonds. So that's what it means. Now you could also read it that the market is complacent. Okay. Now for high yield, H1 means high yield bonds, the credit spreads, option adjusted, is at 287 basis points or 2.87%, which means that high yield bonds are trading 2.87% above treasury bonds in terms of their yield. So it is also considered very tight, but it widened a bit, right? Which basically means that the market is not concerned with a recession. That's what it means. When credit spreads widen, that means the market's like, recession, we're gonna die. But so far, credit spreads are quite tight. Okay. Now, geopolitics. This is the big drama, as you know. One day Trump says, "Yeah, we got a deal, we've got a truce." The next day they bomb the shit out of each other, right? So, right. But I'm told from a lot of people behind the scenes that the US government doesn't want to end the war. They want to keep it going for as long as they can. Why? Because they want to keep oil prices high. Why? Because the US is the biggest exporter of oil. And who's the biggest buyer? Europe. All right. So as long as oil prices are high, the US government is making money from the war. So it's not in their interest to end the war. Okay? Good or bad, I'm not here to judge. I'm just telling you what is in the world. Yeah? So you can see the 10-year Treasury yield, which is the 10-year government bond yield, hit a new high at 4.74%, which interestingly, the market is still holding up pretty well, despite the long-term interest rates going up. And like I said, interesting is that real estate has actually been doing pretty well despite mortgages going up. Scratching my head. And that's why I always say that, forget about trying to make money by predicting the economy or interest rates, because you're going to pull your hair out, okay? I've tried it before, it's a waste of time. Okay, so we've ended July, we're in August. So people like to ask what's going to happen the next month, the next few months. And I keep saying no one can predict the short-term market direction with any certainty. We can just guess. But again, all these guesses are for entertainment. I never put any weight on it in my investment or trading decisions. So please take this with a grain of salt, okay? Now, historically, you can see August, which is this current month, and September, not very good for the market. Well, I guess it's a matter of perspective, right? Well, when I say not very good means normally it goes down, okay? So during midterm election years, which is this year, is a midterm US midterm election year, August, market tends to go down, and September the market tends to go down. Again, is it a guarantee? No, it's just based on history. Yeah. Now, could this be good? Yes, because as value investors, if the market goes down the next 2 months, hey, chance to add more to great companies. Then, historically, October will start weak, but then end up very strong for midterm election years. November, very strong, and December, okay. So last quarter tends to be the strongest for midterm election years. Market will, okay? If you want to see it in a chart form, there we are. Here we go. So the average midterm election year, we have got a choppy time ahead here. And then when it comes to October, November, December, hallelujah. All right, so you gotta hang in there, huh? For the hallelujah. But in the meantime, accumulate shares. Okay, thank you for listening, guys, and may the markets be with you. Next up will be the portfolio review videos.